Guys, welcome back to a new video. And in today's video we are going to take a look at the dollar index, gold, the US 500, the Nasdaq 100, US oil, USD JPY, as well as GBP, USD as well. If you are new to the channel, a sub would be appreciated, as I provide valuable educational content on a daily basis. And if you enjoy the video, please hit the thumbs up for the YouTube algorithm there as well. Today's pairs were luckily selected by our members of the YouTube. And I also just want to say thank you so much for the support that they have been showing and the support everyone else have been showing towards the channel there as well. Now, before we get started, it's very important to understand what kind of news we got coming through this week. First, we got Powell coming through, having a conversation as always. We got the consumer confidence, basically a survey that's done on consumers to say how they feel about the current state of the economy. We've got the core PCE pulling through, and that's the end of the line for this week in terms of dollar news. Now, the reason why we don't need to go and look at news for Nasdaq or US oil or the gold is because all of these pairs are negatively correlated against the dollar index. So when looking at data for the dollar index, we're also looking at the data for these pairs there as well. Now, before we get started, it's important to understand what the current state of the economy is looking like. And it says here, Fed Chairman says he's getting a little bit nervous about going too fast with rate hikes. On top of that, he also said that he sees rates being increased to at least 4.25 to 4.5% by the end of the year. It says here the US Feds will need to raise interest rates by at least another percentage point this year, and we only have 3 months left. So you do the math. Chicago Fed President Charles even said on Tuesday a more aggressive stance than he has previously embraced that underscores the central bank hardening resolve to squash too high inflation. He also said that he does not see a recession hike unemployment rate numbers ahead, even as Fed's action result in below trend economic growth and a softening in the labor market in order to bring inflation back down to the central bank's 2% there as well. Going back to the article from CNBC, CJ spoke to the guys of Squawkbox on Europe on Tuesday. He said that he remains cautiously optimistic that the US economy can avoid a recession provided that there are no further external shocks, which is probably what we're going to see. His comments come shortly after a slew of top Feds said that they would continue to prioritize the fight against inflation, which is currently nearing its highest level since the early 1980s. And the dollar has been enjoying himself of that. Now, jumping over the stock market that we have via stock market today, futures are up as investors gauge economic consequences of high interest rates there as well. US stock futures rose early on Tuesday as traders remain uncertain of the outcome of the economy. Again, it's all uncertainty that's currently going on in the market, especially with the stock market. Investors doesn't know which way to go. Should we buy, should we sell? We don't know what's going on. Next up, we've got Brent crude slides below 85 per barrel as dollar surges. And again, there's a negative correlation between the dollar index and the US oil. So when the price of the oil goes up, you can expect the dollar index to weaken, apart from the situation that we had in Russia at the moment. Now we're going to start with the technical analysis very quickly. On the monthly time frame for the dollar index, we can see once again the market is currently testing very strong level of support, now turning resistance. We can see how the market's back to test it for the first time. So we definitely expect the market to pull back before the continuation to the upside on the weekly time frame. The market now had printed massively and broken above the strong level of resistance, and once resistance gets broken, it becomes support, confirming the pullback before the continuation to the upside. On the daily time frame, what do we see? Now we can see the market is currently starting this correction, and if you take your Fibonacci from the low to the high of this massive impulse, you can see how we have the confluence of the 61.8 almost lining up perfectly with the structural level over here. Now what we can see happening is we can definitely expect the market to continue lower, and then from there we can then further monitor price action to make our next decision. Next up, we do have gold on the monthly time frame, broken below a very strong level of support. Now once support gets broken, it becomes resistance. So we do expect gold to continue higher, but not higher till there, basically till there where the market had spiked that liquidity wick to the downside on the weekly time frame. What do we see? Now from a weekly perspective, it's quite clear that gold had printed massive important structure that we can expect the market to pull back to, as well as identified from a monthly perspective. On the daily time frame, we can see how the market had broken below the strong level of support after being in consolidation for an entire week, and then the Feds came out hiking interest rates, and we have this massive impulse. After an impulse, you expect a correction. We've got the confluence of the 61.8 lining up perfectly with a previous level of support that is now turned resistance. I can definitely expect gold to continue higher. Once again, from there we can monitor the price action and make a further decision. Next up, we do have the S&P 500. Also, the S&P 500 currently trading at a strong level of support. Now you can see how the market is currently starting that correction. We have this massive impulse. After an impulse, you expect a correction. Taking out Fibonacci from the high to the low of the massive impulse, we can see we do have the 0.382. It's lining up perfectly, or the 0.50, the 0.50 and the 0.32. It's lining up perfectly with the structural level over here, acted as a level of resistance, broken above that, tested it as support multiple times, broken below support, and all of that support's now once again turned resistance. Now we can definitely expect the S&P 500 to continue higher, and then from there we can definitely monitor the price, potentially see how the market behaves there, and we could potentially see the market continue higher to go and test that previous level of support over here that is now acting as a level of resistance. Next up, we got the Nasdaq, similar price action over there. The Nasdaq we can definitely expect to continue slightly higher. We have the massive impulse on the daily time frame. After that impulse, we expect a correction, and if you take the Fibonacci from the high to the low, we do have the confluence of the 61.8 lining up perfectly with this previous level that we have over here. Also, now because the Nasdaq had pulled back slightly, we can definitely expect the market to continue higher before seeing any pullback in the market. Now we can see we have similar price action that we saw on the S&P 500. So again, we have to be very careful that we potentially can see the correction take place. Next up, we've got US oil starting on the monthly time frame. The market is currently testing strong level of support that is now acting as a level of resistance. We have this massive impulse. So after an impulse, you expect a correction, and if you take your Fibonacci from the high to the low of the massive impulse, you expect a pullback to at least a 0.382. We can use that as a long-term target for the US oil on the weekly time frame. We can see how the market once again had broken below this very strong structural level that it had created over here that we could potentially use as a short-term target. We're going to use that there. That level of resistance got broken, tested it as support, market broke below that. And now on the daily time frame, what do we see? Now from a daily perspective, is we can see how the market had just completed this overextended information. After an overextended information, you expect to pull back to the left leg before the continuation to the downside. So there's a high possibility that we can expect US oil to continue higher, and then once again we can monitor the price action from that level over there before looking for any moves to the downside. USD hasn't made any moves yet. Market is still stuck within this consolidation phase, so for that reasons we're gonna have to wait for the market to give us a clear break out of this zone first, and then from there we can potentially start looking for these longs, or if we do get a move to the downside, we can then start looking for these sells to the downside there as well. Okay, and then last but not least, we've got GBP USD. Now we can see over here GBP USD had now pulled back, closed the gap, and we have that massive impulse that we've spoken about. Also, we're trading at current monthly support that was formed in 1985, where we expect the market to slightly pull back before that continuation to the downside. The weekly time frame had served as a very bullish candle, but again the gap has been filled, so we could potentially see this market continue down from where it is now. So that's basically where the gap got filled. And like I said on the last breakdown, we have that massive impulse and we got that correction. We have the pullback to the 0.382. So again, this will be the structural area that we need to monitor, where we could basically, if the market does break above that, which we expect because of dollar weakness, we definitely expect a continuation to the upside. And that's all from my side. Thank you for your time, and as always, cheers for ears.